what's up, everyone? Praful here, and welcome back to the second episode of the Candid Traders podcast, Decluttered. And we have Shreyas with us again. And what's up, Shreyas? First of all, I wish you a very happy and a prosperous Diwali, and
Thank you. Thank you. Happy Diwali, Praful.
hope you're doing really well. And great job, great talk at the Traders Carnival. I'm like, it
Did
was
you get to see it?
Yes. I watched a bit of. I watched snippets, not the whole
Okay,
talk,
nice.
because it was on the
Nice.
I was on the move that day, so I couldn't watch completely, but I saw the snippets. But definitely, you lived up to the expectation, no doubt about it.
Thank you. Thank you, Praful. I mean, it was a lot of fun. I got to meet some brilliant people.
Of
And
course.
the way I look at, we all look at the market is that it's this big playground and we play our little games, right?
Little games in the
And
side.
everyone, and you don't really know what the other person is doing. And there were people who traded in all different kinds of ways. Even on the expiry live trade, we had 5 traders trading 5 different strategies.
Mm-hmm.
All 5 ended up doing well, making money at the end, even though sometimes they're on opposite sides. And that just shows that when you practice the same thing over a long period of time, you've figured out your money management, you'll do well regardless of what you trade. So it was a lot of fun. And the full video I think should be available sometime.
Of course. Guys, don't miss out on that opportunity. Just watch and soak up the knowledge. Yes, the link will be out soon. And Shreyas, when you were talking about, we playing our small little games in the part of the playground and we don't know what others are doing. So, what do you think? Do you think it's to our advantage to not get distracted by watching what others do, or is it better to have an overall glimpse of what all's happening in the market? So, what's your take on it?
So, Praful, that's a good question. And it kind of depends on this, right? As long as you want to just test out stuff, you want to always understand the different ways of playing the game, but you shouldn't let it too quickly affect your trading style. Like, for example, you trade a certain style and you're inspired by somebody else. Test it out, really learn it. Don't try to copy it. Don't try to immediately deploy it. Use your own margin and start taking such trades, because you have no idea what are the 50,000 ways in which that trade plays out. I think the one thing that was in common with everyone there was they're like, I've practiced this form of, let's call it batting or bowling over a period of time.
True.
And I know all the different ways to react. So it's good to know. It's always good to learn. It's always good to broaden your perspective. But I think the only thing I told myself before I went on stage also before live trading was, no matter what they say, no matter what they're doing, I need to shut them out and stay in my world, because
Correct.
it doesn't matter if 10 people have 10 correct analyses or 10 correct trades. If it's not
True.
yours, you're going to mess it up.
Exactly, and that's my whole point. When you have chosen your own trading strategy, I think it's not your first choice, right? You must have dabbled in the markets, you must have dabbled in various strategies, and then you have chosen your strategy. So, do you think it makes sense to again go back and get distracted by what others are doing? What's your take on it?
I wouldn't necessarily call it a distraction. It's important to always keep learning, right? But there's a positive way of taking a learning from something. There's also a way of getting negatively impacted by the noise, right?
True.
So it brings in this whole comparison thing. It brings in this whole,
Correct.
is this better? Is that better? It doesn't work that way. So I think as far as just, let's say I got inspired by something, then I start studying it, I research it. I look at, currently I'm deploying 100% of my margin into a certain strategy. Maybe I can think of starting to test with a small portion, minute portion of that, trying to test something else, see how that is working out. If it's going really well, try to scale it up. And over a period of time, I'll get to see in 1,000 scenarios, how does that strategy play out? And then what I'll end up doing is I won't obviously use the strategy as is. I will find where my comforts lie, discomforts lie. So I'll start tweaking it. I'll say, what, instead of this particular entry, I'll take an entry here with more confirmation. Instead of this risk to reward, I will keep it X, Y, Z. So you sort of make it your own. And at that point, it will work. So I don't think it's kind of works like, okay, boss, This is what I do. This is what I'll do always.
Yeah.
You should be open to learning, but at the same time, it doesn't mean that you throw
Not,
what you're doing
don't just
currently.
blindly copy the
Yeah.
thing. Get inspired from other
Yeah.
things and invest a lot of time, effort in, trying to dial it down to your risk appetite and your behavior, your personality trait, and
Exactly.
probably you'd be better off. If you do your due diligence, then probably it's not a bad thing, right?
There's no replacement for experience. There is no
Absolutely.
replacement for taking your hand, putting it on the fire, getting it burned, pulling it back, and then seeing, okay,
Kind
which
of.
distance is it? Okay, there's no replacement for it. If you want a shortcut, if you want a cookie cutter situation, it's not going to work, right? So
Absolutely.
today's topic, Praful, what are we going for today?
Okay, I thought of, just going over systems versus discretionary trading, because when people come to the Twitter space, they get a bit intimidated with all these, Twitter what do you call that, bios, Twitter bios. They say that quant trader, system trader, algorithmic trader. So there's a lot of misconception and people kind of get intimidated. So we want to declutter that today. How about that?
Sounds good. Sounds like a plan. Sounds like a plan.
Yep.
Right. So I mean, I met a lot of system traders, people who've been doing it for a while, some in future, some in this thing. The first thing that stands out to you otherwise also is that system trading is, as you said, highly misconstrued. Just because you have an algorithmic way of execution, some automated execution, doesn't necessarily mean that you're a system trader. And just because you have no technology which automates your execution, it doesn't mean that you don't have a system. Because actually, Prabhul, I'm sure you'll agree, every discretionary trader has some or the other system, right? You might
Absolutely.
not
There are
be
rules.
automating it.
There are some amount of fixed hard and fast rules, right? So first, before going
Yeah.
deeper, let's just make it very clear to the viewers what exactly is discretionary trading, what exactly is systems trading, and what exactly is automated or algo trading. Okay. So
Right.
systems trading is basically you trade with a fixed set of rules which might or might not be influenced by emerging factors. Like today there's an event, Nirmala Sitharaman is coming to speak something, or there is an election, or there is some amount of RBI announcement or something. So your system may or may not have these kinds of emerging factors factored in, but you work on a fixed set of rules. You have a fixed entry condition, you have a fixed exit condition, you have a fixed take profit, you have a fixed stop loss level. It doesn't matter. And when I say systems trading, the systems need not be complicated at all, right? It can be as a simple system as a 15-minute breakout, ORB, open range breakout. It's a system in itself. For example, it's another system is like a simple moving average crossover, right? It is also a system.
Exactly.
So when people say that quant trader or a system trader or something, don't get intimidated. They just try to sound fancy. They're just trying to sound cool. That's it. So it's nothing great. A lot of people, confuse systems trading with algorithmic trading. Systems trading need not be
Right.
algorithmic trading. Like if I have a fixed set of rules, I can do it manually, or I can deploy an algorithm or a software to do it for me. So both algorithmic
Right.
trading and systems trading is very different. And opposed to both of these, what's discretionary trading? You add some amount of human touch to it. Can I say that?
Yeah. Yeah.
Add a bit of
Absolutely. You
human
can say
touch.
that. So, I mean, the way I look at it, Praful, is that every successful discretionary trader, right, which is what we would qualify as, has to have a system, right? You have to have some
Of
part
course.
of you which is
Correct.
systematic. It could be the way you come up with a view. You study the same data. You say, okay, if this data falls in this manner, there's a matrix, right? You can say,
Yep.
okay, the charts data, OI data, maybe some other data that you're working with. So you have a systematic way of coming up with your view, right? To
Correct.
take your trade. You might have a systematic risk to reward, right? So you might trade on an expiry, say that, boss, expiry best case, I'm going to make my 2%, 3%. So worst case, I'm not going to lose more than 1.5%. If I lose 1.5%, I'm getting the hell out, is also a rule, right? You're also sticking to
Correct.
that. You're defining your risk and reward in a systematic manner. So there are parts of your trade that are systematic, which are hardwired. Like, for example, in my trade, I know that since I'm an intraday trader, I have a hard fixed exit on a mark to market basis. If I'm losing on that day, whatever I was the maximum loss I'm willing to give up, that's a hard exit. So that's a systematic portion to my trading style. Whereas the rest of the trade might, and there's zero automation in any of this. So as far as this whole system thing, I think you put it really well. It's just about having a set of rules. And you can be someone who has 50% rules and 50% you let yourself play around with it. You can be someone who has an 80-20, and it depends. It really comes down to your comfort zone. But how I would put it is, as one of the speakers said, that is Vishal, like, even if you're a discretionary trader, if you don't have rules, like the entire concept of having a system, if you don't have rules, then you're bound to make mistakes, right? As far as at least money management is concerned, minimum there you have to have a rule.
Correct.
So,
exactly. I think I can completely agree with you on that, because like even pretty much like my trading style and your trading style is pretty much the same, right? Like we don't take more than 15% exposure on our total capital on positional trades, and mostly we try to take like credit based strategies, and we never try to catch the trend or something. We try to stay as delta neutral as possible, and we have different modes of adjustment. Like sometimes like I use the ITM options to control my mark to market, and you use a different set of approaches, because like you are okay with seeing a little higher mark to market drawdowns, but me, that doesn't put me in a great comfort state. So I use ITM options on an expiry day to manage the gamma move. So we have different ways of adjusting, but I think when it comes to the hard and fast rule, we both agree that our intraday losses, the loss limit, is kind of whatever. It might be 2% for you, it might be 1% for me, it depends. But if we reach that level, there's no two ways about it. Like we just cut out of the trade. Absolutely. Like we don't ask the question. So that is a system in itself.
Absolutely.
Correct. My entry is a system. Like, I mean, if it's a Monday or if it's a Friday where the DK potential is not that great, so I'd be going with like half quantity or something. That entry is a system, and the exit is a system, and everything in between, the adjustments, like whether I'm, taking additional credit to adjust the position, or whether I'm risking off from the losing side. So that is completely discretionary. It completely depends on the premium behavior and so many other factors. And it can even, influence. I mean, you mean influenced by how you're feeling that day.
Yeah.
Whether your adrenaline is pumping, or whether you're in a sad state. So that depends. I mean, your risk-taking abilities depend on your mood also, right?
Absolutely. And I think here is once again the advantage and disadvantage of having something that is completely systematic. Let's say I'm 100% rule driven. And everything is rule driven. There's no manual intervention. The beauty of something like that is that you will have absolutely no emotion playing out, right? So you won't be afraid or you won't be euphoric as you're taking that trade. But the downside to it is sometimes if you've been in the market long enough, you have a very good market intuition. You have roughly an idea as to what will happen. So the potential edge, that you could have pulled out from there, and I think later I'll go a little bit more into edge, but that would be missing out. Like, for example, if you are for some reason fearful of a certain event playing out, then that could have saved you from taking a stop loss, or that could have, actually put you in a profit despite that event playing out. So I guess that's also the pro and also the con, right? So if you're keeping emotions out of it, that can be a pro. Actually, for majority of new people, that will be a huge pro if they can completely eliminate their emotions, because a new person's intuition is probably not going to be as good as somebody who's been in the market for a little while. But for somebody who's been in the market for a little while and is well in control of their behavior, then it might give them a little bit of an edge. So there's no right and wrong in this. It's personality types. I met one person I won't take names, at the carnival, and they told me, boss, I came to the carnival to learn. So I've deleted my broker's app. I have deleted my broker's app and ensured that there is no way I can trade during this period, because it was Thursday, Friday, because I know myself and I will feel tempted to trade. That is superb understanding of himself to know that, boss, you know that you'll end up doing this and beating your purpose. So instead, get rid of it. So for somebody like that, a fully automated system where emotions don't, would make more sense than somebody who's like, I'm well in control of myself. So
how I would look at it is, for example, when it comes to me, usually I use my intuition to cut my losses. I never use my intuition to make additional profits. So there are a very good number of days where I've missed out on a lot of profits as well. My intuition said, okay, cut out your position, just sit out. And on that day, the market went completely sideways and whatever, like the market was very conducive for my trading style and I missed out on the profits. But
yeah,
on some other days, I'd give it like 50-50. On the other 50% of the days, I also saved myself from taking like the stop losses. So
right.
let's say like after 1,000 days of, completely rule-based trading and the trading which involves some amount of my intuition, probably the equity curve wise we'd be at the same level, but my intuition, since I'm using my intuition to reduce the drawdowns, my equity curve is a smooth growing equity curve without much of the drawdowns, and the system will also reach the same equity curve but with slightly higher drawdowns.
Right. So I mean, it depends, right? So this is very
Correct.
personal. There's no this thing.
Exactly.
But basically, I think the
Definitely.
summary is that, if you're somebody who can, like, use your intuition to the benefit, and you're able to see that over a period of time that's been working well for you, then go ahead and do it. But if you find yourself being impulsive, being like taking profits too early, booking losses too late, like this basic behavior problems if you're having, then completely throw this out the door and make rules for everything. Look, it can be right. So that way. And
now one more thing while playing systems is your unwavering belief in the system, right? Now, how do you reach that state of unwavering faith in your system? By following your rules. I mean, by forming your own rules. So now let's talk about how people form systems, especially the new traders in the market. Like, people have a lot of access to these so-called backtesting websites. I don't want to,
right.
I mean, I don't say it in a negative connotation, but we have like access to StockMark and other backtesting softwares like Opstra. Opstra is not exactly backtesting, but you can simulate the the past events, right? So, what do you think these websites have led to?
Well, see, there are, once again, a couple of things here. First of all, the quality of data available to most of us is not very good. Okay, so first of all, the data is only as good as, the analysis is only good as the data that was fed to it. So first of all, a lot of us don't have access to the best data, especially tick by tick data, intraday data, and all. If you're looking for, you're not going to find, right? Day beginning to day end picture is very different from what happens during the intraday, especially if you're in intraday data. Secondly, backtesting is good. Backtesting gives you the right idea, but first of all, do you know how to do it properly? That's a question people need to ask themselves. Do you know how to discount for the skews in the normal distribution, because the data is not clean? That's the first part. Second part, and this is the biggest misconception I've seen from people, and this can be one of the things that goes wrong, because in your system, you have to make certain assumptions. And if an assumption that you make is that something that hasn't happened before will not happen again, if you're making such an assumption that, people say this has never happened before. People say, you know what? I'll give you an example, Praful. People say between Wednesday and Thursday, Nifty has never gapped up 500 points. Okay, I'm just giving you a blanket statement. I think Nifty has otherwise also never gapped up 500 points, but Nifty has never gapped up between Wednesday and Thursday 500 points. So the system is, let us sell 500 point away call option with or 100% of your margin. Let us sell 500 points away call option. That has to be free money. That is free money. If that is an assumption that you're making, that would be a wrong assumption, because think about it. You're using 100% of your margin to sell a penny call option. Let's say 500 points away, you're getting 2 rupees, 3 rupees, something you're getting. If it just so happens that Nifty gaps up at circuit and hits one more circuit, the equation is this, Praful. If your margin is 1 crore, you're in debt to the broker 5 times that.
Exactly.
You lost all your margin and 5 times over. So an assumption that a system should never make is that it's never happened before, it can never happen again. So that cannot be, which means I don't need hedging, I don't need protection.
I think that's a dangerous start to, building your system. That's a dangerous start.
Yeah. Your system can only be as good as the rules that you've put into it and the assumptions. So them being crystal clear is really important. Being able to control the risk. Now, see, as far as edge is concerned, you want a system that generates a positive expected value over a time. If you've invested 100 rupees, you want the expected value to be positive. Now, don't want to get into too much math here, but people keep using the term edge. So I just want to cover just what is this edge. Edge is nothing but what is your probability of winning, right? How much do you win when you win, right? And what is minus what is your probability of losing? How much do you lose when you lose, right? Most people get carried away by the first part of this equation, and they don't realize that the real thing is the second part of the equation. As long as you're able to control the risk, right? Assuming you have a 50-50% probability of winning and losing, as long as you maintain a positive reward to risk, you will have a positive edge. The one time if you can't control your risk, if your risk goes beyond what you systematically anticipated it to be because you tested it in that way, or you expect you can take a stop loss, if it exceeds that, then even if you've had a positive edge for a year, 2 years, 3 years, one wrong move can bring your edge completely negative.
Completely.
Right? So this is what one has to be focused on, that if you're trading positionally, you have a positional system, the main thing that you need to be focused on is controlling the risk aspect of it.
Absolutely.
And your system cannot throw it out.
And I don't think it just applies to positional, even for intraday. I mean, if, as a trader, your primary focus has to be risk management, right? Like, it's not just like positional or something. So it's a blanket statement. Control your risk.
Correct. So absolutely. But the thing is, in intraday, you always have the opportunity to control your risk.
Correct.
See, if I say my risk reward is 2:1, if I'm starting to lose whatever my anticipated risk is, intraday, I have the ability to exit. Okay. Whereas positionally, I might not always get that ability to exit. I'll give you another story. So I was talking to a trader who, it's like, dude, I take an iron condor, right? Very simple iron condor, basic iron condor management. In case on any day, whatever my max profit is, I start to lose 3 times that. Okay. Then I will just take a stop loss and exit. And I will tell you 9 out of 10 times, not even 9 out of 10, 99 out of 100 times, you will get the ability to exit an iron condor at 3 times the max profit. You will get that ability.
Correct.
Assuming it is like 0.2 delta on both sides, you hedge, let's say on the Nifty 150, 200 points.
Probably
so you will get
which has around 80% POP.
Yeah, 80% probability of profit, right? So now there will be once in a while, and the beauty of it is the trader also recognizes there will be once in a while where I won't get to exit at that. In case there is like a circuit, I am going to take a 15% drawdown, and I'm comfortable with that, because every week if I'm making 1.5%, once in a while I will take a 15% drawdown into a black swan. There's nothing that I can do about it. It's going to go. That is fine. See how he has come up with this entire thing, saying that, look, my risk reward most of the time will be 1:3. I have a high probability of winning. I'm going to win most of my trades. This 3 times stop loss is going to hit only once in a while. And there will be once in a while this black swan that is going to take away 4 months of my profit. Simple.
Correct.
So he has anticipated the entire risk in the system. He has not said that, boss, it has never happened that we've gapped down so much and then like this. He is not doing all that. He has taken, you've taken all the scenarios, all the times, how much do you make? Right? Most of the time, because you have a high probability of winning, most of the time, how much do you make? Sometimes when you lose, how much do you lose? And once in a rare occasion, what is the max drawdown you can take? You're sorted. This is an excellent system. I would call this an excellent system because you have figured out everything. You have not skipped anything.
Kind of cover your
problem will be, the problem will be when somebody says, I'm going to take this trade, which has this huge risk reward, right? So let's say you are using 100% of your margin to be long or short futures or XYZ, and you're holding that position. That is a situation where you don't know, and this will happen very rarely, right? But if you're someone who's used to just putting 100% of your margin into trades that have unlimited loss potential, then you are going down a slippery slope, and it's a ticking time bomb. Your system said that this has never happened. We've never had gap up, gap down more than XYZ. Does not mean it cannot happen.
I'm correct. I mean, we talked about this in our first episode as well, like how a lot of billionaire hedge fund managers who came out on streets with just one bad trade.
Yeah.
And I think that's the deciding factor, right? It's just that
so
one
your
trade.
System, correct. Your system needs to cover all bases. You can't skip a single aspect. You need to come up with, okay, these are all the different ways. And overall, you need to project, you need to first, backtesting in the right way is important, right? So when you talk about backtesting and forward testing it slowly. So with small quantities, whenever you're coming up with a new system, forward test it, see, study how its behavior is, see what you can do to reduce its risk. And you want to always increase your alpha, and you want to decrease your drawdown, right? So that's what you want to go for.
Correct.
And that's how you build it to it. And this one more thing of people, just like, these days, the people who subscribe to algos, there are many good algos out there that people have, but I think it's not something I would do, because as a trader, unless it's something I've run many times, I would not be comfortable just going with somebody else's strategy. So you were working on one, Praful, right? So the automation thing.
Yes, myself and one of my close friends. So we are working on that algorithm. Like, it has come out really well. I mean, even on, let's say, like the previous expiry where everyone took a lot of huge losses, it just took like 2-point drawdown. I mean, 2-point loss. That's it.
Wow. Nice.
It was auto adjusting. It's a strangle. It was auto adjusting, and after some point, it just to prevent the gamma moves, it automatically converts itself into an inverted strangle, so that it is kind of immune to gamma moves. So I'm gonna come up. We're gonna talk about that algo in a separate episode. But what I noticed is you brought the topic of backtesting. So let's talk about backtesting for a moment. A lot of these people have access to all of these backtesting websites, for example, StockMark and all that. And one major drawback is, as you mentioned, the quality of the data, right? The data cannot be 100% accurate. There will be some amount of inaccuracies. And even some of these websites, they give the minute end data. And you know that a lot of things can happen within that 1 minute ka candle. And some of the ticks are not even captured by the charts.
Absolutely.
So that is one thing. And the second mistake from the backtester's side, I mean from the trader who's carrying out the backtest, is the curve fitting, extreme curve fitting of data. For example, they buy like 300, 400 credits on StockMark, and what they're going to do is they select either short strangle or short straddle. They just keep running the iterations, right? 9:20 से लेके 10 o'clock तक entry पे करते हैं, and they keep one leg stop loss from 25%, starting from 25% to up till 75%. And then they see and they find that, the sweet spot, the sweet spot, the over optimized spot. Right. It's just like it's pure curve fitting of the data. And that is why a lot of
doesn't work, and that's the thing. No, it doesn't work in the real market. Like people realize that as soon as they deploy it, because and one thing is, a lot of people coming in with super tech savvy, they want to be as data driven.
Exactly.
But it doesn't work. Yeah.
And the thing is, since you and I are both active on the Twitter space, we have been seeing a lot of these algo traders who came out with the backtested result of StockMark, make it into an algo, because short straddle and short strangle, it doesn't need much of a coding experience to actually start off an algo, right? So all these people, they are in huge drawdown because the market has started to behave slightly differently. And another thing with backtesting is elimination of the positive outliers. So what I mean by positive outliers is the Indian markets started having weekly options, especially in Bank Nifty from 2016, right? So in all these 5-6 years of the time where we had the weekly options, the year 2020 is an year of positive outlier. What do I mean by that?
Absolutely.
In the year 2020, the VIX was at 80, right? And the IVs were 120, 130. And in the whole of 2020, after March, except March, if you started option selling from the month of April, whatever short option strategies you took, whatever credit-based option strategies you took, you would have invariably made money, because we were in a constantly downtrending VIX environment. Now,
absolutely,
any short
the
option
tide is in your favor.
Correct, exactly. And any short option strategies would have made a killing in the year 2020. And without leverage, I have seen some of the strategies have returned more than 150, 200%. Right?
Yeah.
And a lot of new people who do backtests using StockMark and all that, they set this 2020 ka results as the expectation, as the benchmark. And because of that, they formulate a strategy, and in that 2020, they try to curve it. Okay, one strategy is giving 150% by just tweaking the variables, by tweaking the entry or by tweaking the exit conditions, by tweaking the stop loss mechanisms. They try to make it like 170%, that additional 20%. And then they come, like, they post on Twitter like, wow, like, look at this, like, I've found out the best trading strategy, just like it's a money machine, it's a money minting machine or something like that. And then those people will be in great disappointment as of now, because the market is showing like V shape and W shape moves pretty much every alternate day, right? So and the VIX is definitely not in their favor. It's a choppy VIX scenario. So that's the thing. Whenever I backtest, what I look is, I purposely take the worst drawdown scenario and set it as the benchmark, and I try to eliminate all the positive outlier periods. Like if I want to backtest Bank Nifty options, especially on the short option strategies, I don't even consider the 2020 results. I would consider 2016, 2017, 2018, 2019 ka results. 2020, I don't even want that, because that happens once in a decade and the tide is in favor of me. And it's not going to be the case going forward.
Right. You cannot work with a steady IV crash environment in your test. Definitely, you have to cut out the outlier. In fact, Praful, like I met some of these system traders who run this model, and like something that, I mean, they're also working on how exactly can they minimize their drawdowns in a period where the tide might not necessarily be completely in their favor. Now, since they are generally on the credit side, I think what they are also working on right now is that initially they were going for huge daily targets and daily reward to risk. Now they're sort of trying to mitigate that by trying to set a ceiling. I think any system should have sort of this is the max, especially if it's an intraday system, it should have a max loss defined. You cannot let it run, right? It just doesn't work that way, because you don't get to control the second half of the equation if you don't control the risk.
Absolutely.
So I think and this also comes down to certain systems. The nature of volatility keeps changing, and sometimes it doesn't suit you. Whenever it's not going in your favor, that period, you have to bring in different things like controlling sizing, keeping tighter risk management, all of that. I think they're also working on that. There's some people doing really good work on this front, but most of it I find is in a very nascent stage. Like, I mean, there are some really good algos out there, but they're not available for retailers to use. And retailers do have some good algo options, but they're all a work in progress. The kind of algorithms that institutions would be running are on a whole different level. They've spent billions of dollars to put that together, to kind of get like a minute edge, to have the easiest, the quickest order placement, to have the least amount of slippage. They've invested a huge amount over time, and you can't expect something.
The kind of edge the institutions are looking for is completely different than the kind of edge a retailer is looking for, right?
Absolutely.
It's a completely different ball game.
Yeah. So, I mean, as far as like people on Twitter making algos and doing well, yes, they have done well over a period of time. But right now, I think one good thing that I'm finding with a lot of these traders, and I got to meet some of these algo traders, is that they're not arrogant. I mean, it's different. Sometimes, when you meet somebody in person, you get a very different impression than when you interact with them online. They're not arrogant. So they're very real to understand that, okay, look, there were a lot of factors that favored our system previously, which might not necessarily be there now. So what do we do to sort of reduce the volatility in the equity curve itself? What do we do to sort of stabilize that a little bit? Because I met some people who were up 200, 300% in the last year. But right now they've gone through a down phase. And one thing that is good, and this should be a trade aspect for every trader out there, is have the humility to look back at your system and say, okay, I need to make some changes. I need to make some tweaks so that I can sort of stabilize this. You're a sucker when you're like, no, this is how it is, and this is what it happens. And I don't think I met system. Yeah, and one thing we spoke about there as well is that none of the traders there are even slightest form of arrogance in them. They've got all the humility in the world, because
markets make you humble, dude.
Markets make you humble, man. Like, you better get off your high horse, otherwise you're on your way out.
Yeah, markets teach you humility the hard way.
Yeah, so I think this comes back to the whole system thing, or wherein you have to kind of keep evolving.
Correct.
It doesn't matter. It doesn't mean that your system doesn't work in a period of time, you throw it out and then you try to bring in a new system or whatever. But it's about constant evolution. You have to keep working so that you can make slight tweaks in different periods of time. And eventually, when you recognize the different periods of volatility, if you have a period which is very similar to something in the past, you can sort of plug in those specific tweaks, and then you have different versions of the same system for different types of volatility.
Now, I find one point to talk about here. So you talk about, bringing in tweaks to your system, right? And you tweak your system when your system is not performing at its best, right?
Yeah.
So how long will you wait till you start making tweaks to your system? Let's say I have a system which is expected to generate somewhere around 3%, 4% per month. And let's say it's in a drawdown for the last 2 months. Do you right off the bat from the third month beginning, do you want to start making tweaks? Or do you want to give it another 2 months time to come back above water? So what's your personal take on it?
So here, once again, there are a couple of rules that I need to set for myself. So for example, right now, I made a tweak to my system about 3 months back, which said that on any day, which is not Wednesday and Thursday, I'm going to be trading only 1/3, max half my previous sizing, right? So I'm cutting down sizing to deal with the nature of volatility currently. What was the rule I said for that to change? For that to change, I have a very fixed criteria wherein I have daily pricing of straddles, right? So if the Friday pricing of at the money straddle is above 300, then I'll actually go back to full sizing on Friday, because it means that the IVs are high enough that my room for error can be more, and my reward to risk also proportionately increases. So I set a rule, like I'm just giving you one part of the
I'm
rule.
going to stop you there. I'm going to stop you there because again, the people will forget. When you said that the straddle pricing is 300 and it completely depends on the base price of the index, right? Now Nifty is currently 18,000. Yes. So the straddle price is 300. Let's say Nifty reaches 22,000. So you'd expect the straddle pricing to be somewhere around 400. So
absolutely. So the base effect will be correct. There. Yes.
So that's just one point I wanted to address. Go ahead. Sorry to interrupt.
Correct. So at this point of time, so I kind of, this is where part discretion also comes in, right? This is why I'm a discretionary trader. So I need to know that there is enough meat in it for me, that if I do take a larger position size, if I go back, because previously when I was trading larger position size, it was at higher IV environments. Correct. Now, generally, we all know that IV has a tendency to overdo things, right? So you have IV shoots up like anything, and the historical volatility that plays out is lower than that. Correct. It's always like that. And then IV crashes like anything, and then the volatility that plays out turns out to be higher than that. So correct. You kind of want to be on the opposite side of the extreme, assuming correct. That IV always behaves in extremes. Of course, you also need to have risk management in place, that if you get in too early or this thing, then you have to get out with your stop loss. So that also is there. But it kind of comes down to that. So you have a set bunch of rules, and where exactly you need to make a tweak, that has to come from experience. It has to come from having traded the same system over a long enough period that you know where to make tweaks to it. There's no shortcut, Praful. Like you can't come up with, if it is underperformed for, it can underperform for months together and then end up doing really well after that. You can't know these things. So my approach is simple. If I'm at that point of time doing well, as I continue to make profits, Praful, I'll always increase my risk appetite. I always increase my risk appetite as I start making money. And as I start losing money, I always reduce my risk appetite. But most people do reverse.
Most people do the opposite. Yes.
Yeah. So that's kind of how, like, what about you? What exactly do you think at the end of the day should be, like, somebody new, let's say somebody is brand new, they want to come up with a systematic way of trading. What do you think should be like the start, middle, and end of this entire process?
I completely believe that the system should be custom made. You can't borrow someone else's system and expect yourself to stick to it through thick and thin. So the system has to be custom made. Like, you have to come up with the rules. And how can you come up with the rules? By some amount of experience in the market. And how do you gain the experience? With some amount of discretionary trading, with some amount of screen time. And similarly, this experience, this discretion that you used to trade in your initial days, that will help you to come up with the rules. And at the same time, the same discretion is going to help you to decide when to tweak your system and what to tweak your system, until what point you have to let your system, stay under drawdown, stay in the drawdown phase. Right. So I would definitely say that, okay, as you said, nothing beats experience, right? And experience definitely comes from discretionary trading. And when I mean discretion, of course, like, you have to start off with some system, at least just by covering your bases. I mean, bro, let me dabble with the markets, but on any given day, let me not take like 2% of the stop loss, more than 2% stop loss.
Right.
That is a simple system.
Kuch bhi karo, just don't lose a lot of money in one day. Do anything.
Like, at least have some capital at the end of your, exploration phase. We talked about this in the first episode as well, right? So at least have some capital, like, don't lose it all so that you can't even capitalize on your skills. And during this phase, like your discretion will definitely help you to come up with your own rules. And that will be a better system to follow. You can follow that, you can trust that, you have that unwavering faith, and you can expect yourself to stick to that system for a longer periods of time without flinching.
Yeah.
What's your take?
Sounds good. No, I'm completely on board with that. I mean, the way I see it is wherever you get your data from, get clean data. So that first of all, whatever analysis you did to come up with the rules of your system are making sense, right? So it's coming from a right, you've used the right manure and the soil to grow those rules. Secondly, forward test. Don't just back test, forward test, deploy it, see how it's playing out, and don't try to scale it up too quickly. And third is, as long as you're able to control the risk aspect on it, and you're not letting it get way out of control, because it really doesn't matter if you do really well over a long period of time. If you're losing 50% of your account in like a short period of time, you need to have rules to mitigate that, right?
Exactly.
And sort of reduce the volatility of your equity curve. It can't be so drastic, because you lose 50%, you have to gain 100% back. It doesn't work in a linear fashion, right? So, but then in that system, keep a positive reward to risk, right? So say on this particular sold call option, which I'll sell, let's say on Bank Nifty, you're selling 300 points, 500 points away. Keep a reward that you're going for of, let's say you're going for 50 points. Keep a risk of 20, 25. Keep doing this over a period of time. You'd be surprised how good this works out. Something as simple as this, right? Something as simple as this is if the 20 moving average is trading over the 50 moving average, you take a long trade, position. Keep a positive reward to risk, and then you do the reverse and you keep a positive reward to risk. And this is one more thing that, many people shared some really nice strategies at the Traders Carnival, and something that I had stated, and, it's a little bit shameless to state this, but, the question was, if you give, let's say I give 10 lakhs to a novice trader and tell them to follow this pro trader strategy. All right. Like they get buy signals, sell signals, both were future strategies. And I tell you, you have to follow this system. And I give the same 10 lakhs to these pro traders. And I tell them, boss, you do the reverse. If your system gives you a buy signal, you sell. And if your system gives you a sell signal, you buy. And I asked them the question that who do you think at the end of 1 year would have generated positive returns on this 10 lakhs and negative returns on this 10 lakhs? And without fail, every single person said the pro traders, even if they're trading reverse of their system, will make money. Exactly. And the reason for that is because they will always know how to maintain a positive reward to risk, even if they're going exactly opposite. The edge is coming partly from their rules, but it's coming more from their money management. And they will always ensure for 2 rupees that they get, they're not giving up more than 1. Correct. In fact, some of them might say, okay, I will sometimes push it to 3, 4, 5. I'm giving up just 1. The way they're able to hold their winners, cut their losers, that kind of stuff is what defines. So don't overdo it with the rules on the entry and the exit. Focus on what do you do with money management. Correct. Exactly. I think another thing is you have to keep asking the same question on loop to yourself. What do I stand to make? And how much am I willing to lose at every point of time, right? Like I'm in a trade thinking that, okay, this is a good risk to reward. Let's say I'm 15 minutes into the trade. I should keep asking the same question at this point. What is it that I stand to make, and what is it that I'm willing to give up? So this is this question has to run through your head on loop, right? And that brings me to another question. Let's say like you have the perfect data available, picture perfect data, like no discrepancies, no errors, nothing. And now, how much weightage would you give to the back-tested results? So, Praful, like to be perfectly honest, I am an intraday trader, right? So for me, in general, I do not give too much weightage to back-tested results, because an intraday sample size is small enough that it really doesn't make that much sense. But if I was trading across the months, if I was trading yearly trades, maybe then I would give more weightage, because the smaller it's going to be one sample, so that it can be distributed anywhere in the normal distribution. It can be at the 0.5% on either side. It can be bang on center. So I don't give it too much value, but I think as you are building your style, you will sort of come up with how much weightage you give it. And it also depends what time frames you're trading. If you're trading larger time frames, then the randomness in the data will be low. Trading is short time frame like intraday, then randomness will be very high.
True.
So
I'll give you my personal story. Like when we were building one of our first algorithms. So the one of my friend, like who I'm working with, building this algorithm, he is into a lot of this backtested numbers. He's like, bro, like this system did more, this system did more. But I'm into how much sense does that strategy make. I'm not into backtested results, because backtested results is okay. It worked in that period of time, but the markets are dynamic. It might work, it might not work. But I'm more focused on how much sense does your strategy make. How much logic does your strategy hold. So even
right.
I'm not a person who gives a lot of weightage to the backtested result. Let's say like there is a simple strategy which is making like 150% returns or whatever, some stellar returns. Okay, I would definitely choose that over a complicated strategy which generates 250% returns if the first strategy makes more sense to me.
Right. Right.
Correct. In terms
Simple
of,
things work.
yeah, yes, exactly. In terms of, it might be in terms of entry and exit criteria, it might be in terms of risk management. Let's say if I ask the question to all these people like who go to stockmark and do the back testing, bro, come up with a system which gives a decent enough returns. Like someone comes up with, okay, bro, like I take a 920 straddle, which is a very popular, which is a popular strategy, right? So I take a 920 straddle, I keep 45% stop loss on each legs, and if the stop loss hits on one leg, I keep trailing the other leg. Now,
yeah.
if I ask them, okay, do you have the backtested data to support this? Yes, they'll show me the backtested data. Look at this Excel sheet. It has done phenomenally well in the last 3, 4, 5, whatever number of years. But if I ask them, what is the logic for keeping 45% as the stop loss? What is the logic behind that?
Maybe that they find that in the normal skew of volatility up down, that there can be an expansion within, let's say, maybe this particular range, so they don't want to get stopped out too early. Maybe they tested how often do you get stopped out versus how often is that the critical point beyond which you know that it's not going to come back. So some sort of logic like that.
Right.
I'm
If they
guessing.
approach this problem with this kind of an approach, with this kind of an attitude, I have absolutely no problem implementing that system. But if they came to if they came to a conclusion that 45% stop loss is the optimum way just by curve fitting the data. I mean, they just ran the numbers starting from 5%, 10%, 15%, 20%, right up to 75%. And then they looked at the backtested results, and this 45% ka system had done extremely well in the given sample space. And then they're coming to me saying that, like, bro, this 45% stop loss system works. Definitely, me personally, I wouldn't accept that. What about you?
Well, so see, it's kind of like this. You have this distribution of data. Maybe it just so happens that that result would come because in most days, maybe if you had kept 35% stop loss and 35 is showing less profitability, then it would mean that 35 gets hit and then high chance of reversal. So if you want to look at on a probability basis, the least chance that you have your SL hit and then a reversal, in which case you're going to bleed both sides. Maybe that's how it came out. I guess, I mean, I wouldn't make a blanket statement about it, but I would look at how, as you said, right, how logically has this number been arrived at?
Exactly.
Knowing that in behavior, because lately you've had thousand moves in random direction, 1,000 points
Exactly.
up, 1,000 point down, and this would consider an outlier. You have both sides stop loss hit. You can't do anything about it. This is probably part of that system, but yeah,
Yes, of
I
course.
don't know.
Like
I think it would depend.
yes, there are days like these. There will be phases like these where all the systems, pretty much, if you go to the Twitter space and see all the timelines of these good system-based traders, pretty much most of them are in the drawdown phase, right? Because the kind of volatility that we are seeing in Bank Nifty, 1,000 point up move, 1,000 point down move, again 1,500 point up move. So none of the systems can handle these kinds of volatility. I think even pretty much like institutional algorithms would also be taking some amount of hit during this phase. But
Definitely.
my only concern is when you're forming a system, when you're building a system, what is the approach that you're building it with? I mean, are you trying to, too much depending on the backtested numbers and trying to curve fit the data? Or are you going to approach it with some amount of logic? Bro, this is my rule. Okay, this makes sense in the current market condition. Let me backtest and see whether the history has supported this hypothesis or not. I would go with this
Right.
approach for backtesting. I would not go,
Right.
okay, like I'll backtest, I'll run different, set of numbers, and then I'll take the best possible this thing, and then I'll come trade with that. I would definitely never do that.
Right.
I mean, I give more weightage to the logic and how much sense my system makes over the backtested result.
So you want to go bottom up instead of top
Kind
down.
of.
This is
Because
right. Yeah.
it comes down to how comfortable you're with the system. Because if the system makes more sense to you, the probability of you sticking to that system is much higher, right? Let's say like that person,
Yeah.
we'll go back to the same example. Let's say that person comes up with a rule saying that 45% stop loss on each leg. I would say that this person is most likely to change his system sooner than you think, the moment the system goes into a drawdown. Why? Because the only comfort factor he has is the backtested results. He doesn't have the logic formed by himself. But let's say
possibly.
But let's say like someone came up with a logical stop loss, like he has a very firm belief. Let's say even if the system goes into a drawdown, he believes that, okay, this is just a phase. I'm going to stick to my system. I mean, this answer definitely has a personal bias to it, but yeah, that would how I look at it.
Yeah, I'm looking forward to once you have your automated thing. I'd like to test it out. Should be a lot of fun
Yeah,
to
course,
let
definitely.
it. Yeah. Regardless, I think on a conclusive note, this was like super interesting. I hope we managed to declutter it. I think something else that should be super evident from our conversation is that this is it cannot get more unscripted than this. At this point, we're just rambling, whatever comes to mind.
Correct.
So yeah, in fact, so what I was thinking is if people like this, then I think there's a part disservice that we're doing here by not having a full-time system trader being a part of this conversation. And what we can do is we can do like a part 2, and I'll try to like have one of the 100% system traders, people who don't have any amount of discretion in their trades. Maybe they can join us, Praful, and that'll be really nice because then we'll have like that contribution to get that perspective. Yeah.
Perfect. We can ask our audience like if they have someone in their minds.
Yeah.
If you have some trader who's been very profitable and who's been 100% systems trader with zero discretion, if you have someone on your mind, write down their names in the comment section. We'd be more than happy to approach them and get them on our show. And if you want us to talk about the same thing, same topic in part 2 of the video, let us know in the comment section. And it was super fun, dude. Like, it was amazing having this conversation.
As always. No, this has been fun. We couldn't do last week episode because of the carnival, but yeah, let's just keep picking up topics like this and going on. Some people will throw tomatoes at us saying, what is this? You guys are sitting and chatting about like, in a very unstructured manner. That's kind of how we'll keep it. So yeah, I
think let's not make it way too formal and way too structured. I mean, people would love to hear our candid thoughts. That's what I personally feel like. If we start like coming out with filtered content, that's what like pretty much everyone does.
Yeah,
pretty much
exactly.
The YouTube space is filled with all filtered content. So let's give them the reality. Let's give them the decluttered picture. Let's keep it as candid as it gets.
Sounds awesome, Praful. Anyway, it was a pleasure.
Same here,
and
man.
Thank you all so much for watching.
And thanks everyone for watching. And I wish everyone a very happy, prosperous, and safe Diwali. So be safe while bursting firecrackers for the next couple of days, and always be safe in the market, no matter what.
Yes, happy Diwali to everyone, and may this year bring in a lot of light and prosperity to all of you, and I wish you the very best. And yeah, take care. Bye-bye.
See you. Bye-bye. Take care.
Bye.